Welcome back, everyone. I'm Robert with Open Land Funding out of Spokane Valley, Washington. If you're an investor, a landlord, or anyone thinking about buying or financing real estate right now, is the video you need to watch before you make a single move. Over the next 9 days, I am going to break down the most important real estate market data available. And today, I'm going to give you the full overview so that you know exactly what is coming and what it means for your money. So let's jump into it. Let us start with the mortgage rates because that is where the engine that drives everything else. As of today, the Freddie Mac 30-year fixed rate is sitting at 6.37%. That is up 14 basis points since the April 23rd low of 6.23%. If you're shopping daily rate quotes, Bankrate is showing 6.45% to 6.47%. For my investors who use DSCR loans, the best case floor for a qualified borrower at 700 or above credit score with a strong debt service coverage ratio is now at 6.12% to 6.25%. Standard investment property loans are running 6.75% to 7.75% for most borrowers. And that's a give or take a little. Here is the big picture for Federal Reserves. The rates held steady at their April 20th and 29th meeting. But the vote was the most divided since 1992, with an 8-4 split with the Hawks dominating. The probability of zero Federal Reserve rate cuts in all of 2026 just jumped up to 57%. And tomorrow morning, Tuesday, May 12th, the April Consumer Price Index report comes out, and that single number might will likely move rates up or down by 15 to 30 basis points before the week is over. So coming up on Tuesday, I will do a deeper dive on exactly what rates mean for your deal right now. But now let's talk about where the money is being made and where it's being lost. The national home price picture for is complex. The Case-Shiller National Index shows homes up just 0.7% year over year through February. The Zillow is also now forecasting only 0.3% appreciation for all of 2026. But here's what matters for investors. The market is splitting into two completely different Americas. The Northeast and Midwest are outperforming everything. Chicago is up 5% year over year. Milwaukee is up 5.3%. Hartford and Cleveland are both showing strong appreciation areas as well. These markets have one thing in common. They are significantly below pre-pandemic inventory norms. That is with the Northeast still being at 51.6% below normal supply levels. That structural shortage, it's not going to go away. Meanwhile, the Sunbelt correction is real and ongoing. Austin is down 6%, Dallas is down 3.3%, Tampa is down 2.1%, and Denver just became the weakest major market in the entire Case-Shiller 20 City Index at negative 2.2%. That is and that matters because Denver also used to be a darling investor market for Washington state investors. The Mountain Division, which includes our region, is the worst performing division nationally on a monthly and annual basis. And I will spend more time on exactly what that means for Spokane specifically. And in the rental market, this is right now is a genuine inflection point, and I want investors to pay close attention here. The national vacancy rate is sitting at 7.2%, and that is actually down slightly for the first time in more than 4 years, according to Apartment List. The first vacancy decrease in 48 months is a meaningful signal, but do not get too excited yet because the CoStar is forecasting that vacancy will climb back up to 8.8% by year end. And the Yardi Matrix just recorded the first spring month with a negative year over year rent growth since they began tracking. The story by market is dramatic. San Francisco rents, they are up 19.9% year over year. That's an all-time record. And it's all driven by artificial intelligence sector hiring. Chicago rents are up 8.3%. Those are the winners. Now on the losing side. Nashville rents are down 9.4%. New Orleans, they're down 13.1%. Cape Coral in Florida is down 9.1% with a 11.3% vacancy rate. If you own a rental property or you're looking to buy, knowing which market bucket you are in could be the difference because a deal that cash flows and one that bleeds money every month. Now, let me give you the foreclosure picture because this is where sophisticated investors are starting to pay very close attention. Active foreclosure inventory just hit a 6-year high nationally. That's with 273,000 units as of March Intercontinental Exchange first look report. Foreclosure starts are up 17% year over year. Foreclosure sales, the actual auction activity, are up 21% year over year. For fix and flip investors specifically, the auction.com first quarter 2026 report shows foreclosure auction volume is up 33% year over year with a 6-year high. And average equity on scheduled auction properties has dropped 26.9%, meaning sellers are pricing to move. They're not holding out anymore. That is an opportunity window for buyers who are ready to act. Here in Washington State, now this hits close to home, bank-owned property inventory is up 115% year over year. Colorado is up 224%. Florida is up 108%. And I will unpack what all of that means specifically, nationally, and for our market. And that let me hit the macro picture because it sets the entire table. The market grew at 2% in the first quarter of 2026. That is solid. April additions came in at 115, beating expectations. The unemployment rate held at 4.3%. And on the surface, that all sounds fine. But underneath the surface, inflation is the real problem. The personal consumption expenditures price index has the Federal Reserve, and that's the Federal Reserve's preferred inflation measure, came in at 3.5% year over year, and that was in March. And the embedded inflation measure in the first quarter gross domestic product report hit 4.5%. Energy prices jumped 11.6% in a single month due to the Middle East conflict premium. The consumer sentiment is near its lowest point since June 2022. The tariff cliff is coming on July 24th, and that is when 10% of the tariff structure expires. That's another wild card. The Institute for Supply Management Manufacturing Prices Index hit 84.6% in April. That's the highest since 2022, which which is a 2 to 3 month leading signal for consumer price inflation. The bottom line, the Federal Reserve is stuck. They cannot cut rates with inflation data, and that means mortgage rates are going to stay elevated for longer than most people were hoping at the start of the year. Now let me bring this home, literally, to Spokane and Coeur d'Alene. The Spokane Association of Realtors just released April data, and it tells a nuanced story. Closed sales are up 9.8% year over year. That is real transaction activity, and pending sales are up 14% year over year, and that tells you that demand is alive. But, and this is a big but, the median sold price fell to $420,000, which is down 2.8% from a year ago. That is actually a deepening decline from the negative 0.7% that we saw in March. So that means prices keep falling right now. Active inventory is up 19.5% year over year. That's with a 3 month supply, or that's with month supply at 2.4%. Still technically a seller's market, but it's all loosening. For the resale segment, specifically, active inventory is up 24.2%. And that is a buyer leverage story right now in Spokane. Now, over in Coeur d'Alene and Kootenai County, they saw something significant, and it's happening with their inventory. County-wide, active listings have jumped from 778 on April 3rd to approximately 1,900 as of May 4th. And that is a massive spring surge in just 30 days. That directly affects your exit strategy assumptions if you are doing a bridge loan or a fix and flip loan in North Idaho. On the regulatory side, two major deadlines are coming in June. The Spokane Eviction Diversion Ordinance kicks in June 1st, requiring a 30-day diversion process before non-payment eviction filings. Washington State Senate Bill 6026 takes effect June 11th, requiring by right residential development in commercial and mixed use zones in cities over 30,000. The second one is actually an opportunity for value add investors in commercial corridor properties. Finally, let me give you the ranking scorecard. And the hottest sales market in the country right now, according to Realtor.com, is Springfield, Massachusetts. Homes are selling in 23 days, drawing 3.6 times the national average views per listing. Connecticut holds 4 of the top 10 spots nationally. The Wall Street Journal and Realtor.com Spring 2026 quarterly ranking puts South Bend, Indiana at the number one spot, up 14 positions in a single year. That is amazing. The coldest markets, where are they at? The bottom 25 the bottom 25 of 44% uh, are sitting in Florida, and 36% are sitting in Texas metros. Toledo, Ohio went from the number one hottest market a year ago to number 38 today. And that's a cautionary tale how fast markets can turn. For rentals, Miami holds the number one competitiveness score, but Chicago just surged to number two with a 9.5% jump, the biggest move of any major market. San Francisco is up 6.1% on the artificial intelligence sector demand because of it. And on the cold end, you got Cape Coral, you have San Antonio, you have Phoenix, you have Nashville, and Memphis. They are all showing double digit rental decline or vacancy above 13%. And then, so this is going to be where I wrap it up. Here's what I want you to take away from today. The market is not uniformly good or bad. It is deeply divided. And where you invest and what product type you use and what your financing structure looks like, that has never mattered more than it does right now. Over the next 9 days, I'm going deep on each of these topics. On Friday, I will be covering the strongest appreciating markets and what the economic data means for your investment strategy. Next Monday, we will go over local with a full breakdown of Spokane and Coeur d'Alene. And we will close out the 2 weeks on Friday, the 22nd, with a hottest and coldest markets breakdown and a complete investor action plan. If you are working on a deal right now, a DSCR loan, fix and flip, bridge loan, new construction, reach out to me directly. Links are in the description. I'm Robert with Open Lane Funding. Hit like, hit subscribe, drop a comment with your question. I'll see you on Tuesday. Thank you, everyone.